Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for Wealth Press. Today is Thursday. It's finally Thursday. It's Friday Eve, as someone I know likes to call it. It's May 12th. It's about 7:47 in the morning. The market's going to be starting out in about an hour and 40-ish minutes or so. And as we can see here, the NASDAQ is taking it under the chin, and so is the Dow Jones. Now, why is this happening? Well, because the report yesterday of the CPI wasn't low enough. Inflation is higher than expected. U.S. inflation data that was higher than expected. And I told you guys, if the number is on the higher end of the scale, that's going to say that the Fed will say, we told you so, inflation's really hot, we really got to take action. If we had the opposite number, markets were actually gearing up pretty good yesterday. They were up about 300 points before the report came out yesterday. But again, the report came out completely on the total upper end of the range. A report from the U.S. Labor Department showed that inflation slowed a touch in April, down to 8.3% from 8.5%. The data suggests that consumer price index may be peaking and set to ease further. I'm hoping that's the case, and I think that will be the case because the markets tend to price in everything that's known. But the decline was smaller than hoped for and reinforced expectations that the Federal Reserve will continue to raise interest rates to counter rising prices. And that's why the market has been soft lately. On Wednesday, Wall Street, S&P lost 1.6%, the Dow lost 1%, and look at the NASDAQ, 3.2%. Again, tech heavy. And economists said that the inflation report will keep the Fed on track for rapid and potential sharp increases. Now, such moves are designed to slow the economy, to quash inflation, but there's a risk that it'll also put pressure on cryptocurrencies, high growth stocks, big tech, which is why we've been in gas stocks, consumer staples, not consumer discretionary, dealing with things people need, not people want. Now, let me show you something interesting. If you look at the SPY, and I think this is really, really interesting, and this is very, very telling. If you look at the SPY, it crapped out pretty good yesterday. I mean, look at this. Crapped out. Lower lows, right? But look at the VIX. Look at the VIX. The VIX couldn't go high. It couldn't. Look at this, going lower. I mean, it's making lower highs. That's what I'm trying to say. It's not going lower. It's making lower highs. And again, if you look over here, if you look at it this way, if you look at it like this, you will see that we are not at these levels. So the VIX is saying, hold on. Also, as I was saying the other day, we're starting to see, and these subtle changes are very, very important. We're starting to see the communication sector. Look at this. It was down 1.81% yesterday. But look at tech. 3.5%. That's consumer discretionary. 3.5%. And already pre-opening down 4%. And look at tech. Again, notice 3.6% and already down 4% pre-open. But look at communications. Look at that. Down only 0.7%. And look at the low yesterday. I said this to you guys several days ago. That's very, very important because the communication sector was, in fact, the most lagging sector. So, for example, if you look here, if I can get this thing to load, it's not loading right now. I could do it over here. I could actually do it on bar charts. I'm pretty resourceful these days. So here you could see here. Let me go back 5 days. You could see here in 5 days, look at communication services. It's no longer here. It's now fourth spot up over the last 5 days. Now let's look at it on a month. On the month, it's number 3, but it's not the lowest one. And I think that's really interesting that the market continues to go down, especially the NASDAQ, but the sector that's been leading us down is no longer going down. I think that's very, 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 very important. And the bar chart is showing me the same thing. Now, today, this was the nasty report we had yesterday. Today, we have jobless claims and PPI. Producers Price Index is not as significant as the CPI, but that'll also give us some indication of how the producers are gauging inflation and how they're fighting with it, and then we'll have the jobless claim. I'm not really anticipating much out of the jobless claim. I think the jobless claim will be okay. I think it'll be fairly stable. But the PPI number really could be significant. It's just one of those things that could be significant. Let me just show you what the expectations are. So year over year, they're looking at 10.7 to 11.5%. And again, it'd be very interesting to see what it is ex food and energy, because we've been getting a lot of inflation in energy and food. But the target is 10.7%. We'll see what that number comes out at. Let's see if we got Stock Fetcher working now. All right, here we go. So if we look at the 11 major sectors, and again, communication services still lagging on a cumulative basis, but when we go up to here, communication services is ahead of consumer discretionary. And again, 2 days ago, it was ahead of real estate as well. This is something we have to be very, very mindful with, because that was the most lagging sector of the economy. Now, looking at levels, let me give you guys levels. Very, very important to have levels right now. Now, the S&P is grossly oversold. I mean, this is grossly oversold. The first thing I'd like to see is come back to 412. That would be my first buy zone. Otherwise, I'm waiting for a pullback, and this thing is going to sell lower. But again, look at the crazy divergence we're seeing. Look at this divergence. I mean, look at downslope and look up here. This can barely go down to 27. So the point is the market's oversold. If you look at the QQQ, this is just craziness. This is a very, very oversold market. And that type of market looks like it's going to turn around. I mean, look at the divergence. Higher prices, lower prices, way, way down. But again, see this low right here? Look at that. Now look at XLC. Not cooperating. Not cooperating nearly as much. Notice it's flattening out. Now, when we're looking at the bond market, and we'll look at TLT, you will see that the bond market is now starting to finally head higher. Even right now, it's starting to head higher. That's very, very positive, because that's telling us the long bond can't assimilate the current interest rates going much lower at this time. Higher at this time, excuse me. Bonds going lower, interest rates going higher. If that is the case, and if that is the position where we're at right now, I think the best thing to do is hold on for this thing to go a little bit higher and then sell it, because we want to go with the trend. Because look, we know interest rates are going to go higher. So even if we're wrong on the trade will save us. But I'd like to see us hit the 50-day line, or maybe go a little bit higher, because I believe we're going to see more downside in the bonds. But for now, the bonds are saying we're done. And they're finally starting to react to the market going down, which is telling us that the Fed may be very, very close to slightly adjusting their policy, telling us that they're going to hold off. But the fact that the bonds are going up is flight to quality. That means investors are at least buying bonds right now. So again, it'll be very interesting to see how it folds out. Keep your eye on the bond market. We could have gone higher up, but I prefer to have sold it, and I'm only going to go with the trend, because look at the trend. But it looks to me like this trend may be pausing for a little while. And if that's the case, we may get a relief rally. Now, I've been showing you this almost every single day, but I need to remind you of this, because this is really, really important. If you look right here, look at the number of stocks above the 50-day line in the NASDAQ. Look at this. Look at that. Look at it over 20 years. So right now, this is 2008. Look at where we're at right now. We're at 2008 levels, folks. We're below 2008 levels. This is 2015. This is 2018. This is 2020. We are below those levels right now on the NASDAQ. So, folks, the end of this is going to come much sooner than you think. We're not just going to stay in this level. Now, theoretically, we can kind of hover around here for a month or two and go higher. But as far as downside, I think we're pretty limited. And when you look at the number of stocks in the 200-day, look at this and look at 2008. So we're very, 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 very much near this thing in terms of elasticity. It just doesn't look like much. Let's look at the S&P. I haven't really looked at the S&P. Let's look at the S&P and see how that one looks. Or why don't we just look at the broad market, right? This is any stock over $2. Let's take a look and see how it looks. I mean, look at where we're at right now. Look at this. This is 2008. Look at where we're at right now. This is 2020. This is COVID. This is 2008. Look at where we're at right now. Now, Look at number of stocks. Look at the 200-day line. 2009. Look at this. Look at COVID, and look at where we're at right now. I mean, we're really getting down there. So, do I think this is time to throw the baby out with the bathwater? Absolutely not. I think the market is getting ready to. I think the market is shaking out the weak hands and is ready to go higher. Volatility did not go higher yesterday. We're near the bottom end of the range. Bonds are finally going higher, and the sector that was lagging behind is no longer lagging behind. Now, today is Thursday, and on Thursday, what do? I always give you guys a top ETF and option. Right now, I still like natural gas. Let me show you the graph. I think we're still going to have a lot of turmoil with energies and all the other stuff that's going on in the world. So as you can see here, we're near the highs. We're above the 50-day moving average, and I think natural gas is going to go higher. Matter of fact, I'm pretty sure of it on a global basis. So let's take a look at an October option. The October option, I would probably go right here, right around the 27-ish area. Plenty of open interest right here. That's what I would probably end up doing, right in this area right here. You got a good sweet spot. You got good volume. You've got good open interest, but it's all right in this area right here. Again, you're going October. It's 163 days. Even if we don't have a lot of movement in the next 40, 30 days, you still got plenty of time. But you want to go far out because we're going to have a lot of volatility and movement. But also, if stocks start going higher, this may see some subdued trading action. So be very, very cautious right now because volatility is really, really high. Now, before I let you go, folks, we've all been there before. Traders buy the dip in their favorite stock, but then the dip turns into a correction. And then that correction turns into a crash. All of a sudden, 2-3 months of gains are wiped out in 2 to 3 days. This is what we call blowing up an account. And we see new traders making this mistake all the time. I mean, I hear it all the time. The key here is using a built-in hedge for protection and not one that you put on after the fact, the one that's always there. The hedge allows us to take full advantage of the potential upside and the downside. And when the markets crash finally happen, we're protected. Plunge protection. I love that, plunge protection. Click the link below to watch how my rotation strategy could help out during these volatile times. We've been actually doing really good with the strategy during this crazy volatility. Check it out. Follow the link below. And tomorrow, weekly recap, biggest winners, biggest losers, and what to expect the following week. Have a great day. Follow the link. If you're watching this on YouTube, go to the Wealth Press YouTube channel, it's in the descriptor, the link. And post some comments, post some feedback. I want to hear from you. If I've been helping you, let me know. Post some feedback or send me an email, support@marketgeeks.com. Bye. Have a great, great day.